Welcome to Central Bank Central. I'm Kathleen Hays. So today, as pretty much expected, the Fed Reserve held its last meeting of 2025 and did deliver its third and last cut, at least for this year. The question is now, where does the Fed go next and how quickly do they get or not get there? So I'm very happy to welcome back to Central Bank Central Esther George. She's former president of the Federal Reserve Bank of Kansas City and someone I've been talking to about all these monetary policy questions and more for many, many years. So, Esther, give me your headline. What's your overall impression of this meeting and what has come out of it? What's the message from the Fed?
Yeah. Well, good to be with you again, Kathleen. And I think what was not news was, I think, the cut itself expected, and a lot of speculation about how many dissents would come along with that to give some idea of, is the committee really together on the drivers of these cuts? Are they beginning to pull apart? And so I think, you added as a cent today. So two people thinking no cut, one continuing to want to push for deeper cuts. But I think the message today was the Fed is not worried about inflation, despite the fact it is running at 3%. They believe that that 3% is really coming down, that tariffs are not going to be a driver of higher inflation, and more worry about the labor market. They've continued that concern that the labor market is weakening and characterizing it as, equal, but risk either way that they go. So they're leaning on the labor market. The other piece that I really caught my attention was 40 billion a month to be added to the balance sheet. So the chairman referred to it as reserve management purchases. Nothing to see here, nothing to do with monetary policy. And yet I think the market reacted quite positively that this was going to bring some easier financial conditions into the picture. So,
Well, of course, let's go directly then to the bill purchases, Treasury bill purchases, and of course, Treasury is issuing a lot more Treasury bills than they are longer term securities. It's a big shift in how much they've been doing compared to past presidencies, past Fed chair episodes, right? So, and they would argue it has a lot to do with liquidity, and we're on this different system now where it's ample reserves versus scarce reserves, and we don't need to get too much into that. But Chair Powell, when he was asked about this big, the earlier move to the Treasury bill purchases, it was going to happen. No, but people figure it would happen later after the first of the year. He seemed to downplay that. This is just what we need to do to keep liquidity and where it needs to be so banks can work, so, financial markets can work. Why don't you see it that way?
well, remember the context in which these purchases are taking place. So the Fed continues to have an outsized balance sheet. Its footprint in this Treasury market is a large one. They just completed the quantitative tightening, the roll off of some of these assets. It also is in the context of a treasury that is facing large issuances. So we have a $2 trillion deficit that has to be financed. We see the pressures that are going to come from having high interest expense for the federal government. We're now up to $1 trillion in interest expense. The pressures are only growing on the Fed to manage the rate environment. So think about what the Fed has done over the past year. Its rate cuts have not actually lowered longer term rates. They have continued to stay high. Now we'll see what happens this week, but as they intervene in the market, as they add more reserves to banks' balance sheet, again, the rationale was to get ahead of the April tax day when when people would be remitting payments to the Treasury. I think it is just a cautious time to watch the Fed, whether you call it market functioning, QE, or reserve management purchases. You are in the market buying up what is a growing amount of Treasury product that needs to be purchased.
Well, so is the criticism that the Fed has made a balance sheet that's so big by doing all these interventions via either purchasing or selling treasuries? Mostly it's been the longer term treasuries, but that is something that now they're stuck with a certain kind of position. And is that just, but is it still more of a technical kind of thing? Is it something that a regular person whether they're just thinking about what the economy is going to do, or maybe something more like where they should invest if they have money to invest, that they need to be aware of because it's a potential something potentially that upsets the apple cart a little bit, or
Yeah.
what is the impact on the broader picture of the economy and the markets?
Well, I think clearly the Federal Reserve is going to tell you it's a technical move. That to maintain its ample reserve regime, which remember, as they pay interest on those reserves, it is helping them control their target, which is the Fed funds rate. That is going to be the official explanation for this. But even with that, you are putting money into the system. You are essentially buying up the treasury product that might go elsewhere, and it does affect the pricing of risk in the market. So absent that purchaser and absent, the rates reflecting in its term premium what that is, I think that's what you have to watch. So we'll see. If it's 1 month of $40 billion, maybe it doesn't amount to much, but it begins the process of being in a position to manage market functioning, which I would argue is not clearly the Fed's mandate. It has happened in times of crisis, and we understand what the Fed is trying to do during that time. But to do it in a time when the economy is growing, when things seem to be relatively stable, is an unusual move. And I think it does reflect, to your point, it is a more complicated monetary policy decision making process when you have this ample reserves regime right now.
Hmm. Well, let's leave that one not ended, but let's move to the Fed funds rate and the fact that Federal Reserve cut it. Now, that was pretty much widely expected, in part because key players like Jay Powell, like John Williams, who's president of the New York Federal Reserve Bank, which means he's considered right there at the top in the leadership group, right? Right up there with the chair and the vice chair. Maybe some would call him third in line. Okay. So but was it a couple of weeks ago? He gave this speech, which said he expected a rate cut in the near term, which wouldn't have necessarily meant today. Maybe wait till January, but it didn't. So, is this a what kind of is this a dovish cut? Is it a hawkish cut? I mean, one thing it was interesting if you're listening closely. The Jay Powell talked about the Fed talking about the next move, what he thought might happen or what they're watching. He didn't say our next cut. That could have been super dovish. How do you take the
Yeah.
wording and the setup that cut got from Jay Powell?
Yeah. Well, he also was pretty clear, I thought, in his statement that no rate hikes were on the table as they look out. So I think you're left with looking at this to say, will they pause, and the next move would be a cut? Are they waiting for this uh, rash of data that is already stale to come through and give them a better sense of where's inflation, where's the job market right now? Then when January comes, we can talk more about where we see the economy. So I didn't think it was a hawkish cut. I thought he tried to keep it relatively neutral to say, we've done 75 basis points. We did 100 before that. We think we are basically in the range of neutral, which suggests this might be a resting point as we wait to see what the economy looks like with these data releases and other things.
Well, of course, the dots when the Fed issues its summary of economic projections, which gives forecasts for GDP, that's growth, unemployment, that's the labor market, and inflation. And then from there, each of the 19 members puts out, their names aren't attached to their forecast for the funds rate moves or lack of funds rate moves, but that did seem there are clearly some people who don't see any rate cuts next year. And the median tends to be what I think one rate cut next year, which that doesn't seem too much more
Yeah.
aggressive in terms of speeding up the economy. So how did you read the dots?
Yeah, I read the dots as having a pretty strong core of people that want to pause. And I think had they been voters, they would have wanted to pause at this meeting, even before going into next year. So I think next year is really a time to reassess. And I'd be surprised if they continue moves, during the first 5 months of the year, as long as the chairman is in his seat, because I think there is a strong sense that inflation has not moved in the direction that it should by that cohort. And those that are worried about the labor market, I thought the arguments today didn't emphasize enough some of the supply side issues hitting that labor market, which would suggest that these rate cuts may not change the direction there. Now, again, there are revisions to the benchmark data. The chairman talked about how the surveys will be less reliable and helpful. And so we'll have to see what we can glean from the data coming out. But I think today what is clearest, in my view, is the inflation trajectory and continuing to rely on expectations of inflation coming down and pushing that date out further, I think runs some risk for this committee when they can directly affect that.
Exactly. And it strikes me that Jay Powell really doesn't seem worried about the fact that inflation is up near 3% and the Fed keeps forecasting it to come down more. Maybe it finally will. But there are a lot of people worried that no, it's not going to come down. And that when you look at expectations, a couple of things. There's different surveys, and the Fed always takes the survey that is the most friendly, and that one of those is the New York Fed's survey, which is only about 8 years old. Unlike the University of Michigan Consumer Sentiment showing that survey talking about inflation expectations has gone up a good bit. And
Yeah.
there's also one more thing I want to mention about from your former FOMC colleague Loretta Mester, former president of Cleveland Fed, who when
Cleveland
we
Feds
spoke
were.
about a month ago, she said that if you look at the Cleveland Fed's business expectation survey, it shows that what people had been saying in the survey was inflation, the Fed's target 2%. Now that moved up to saying the Fed is looking at 2.5%. So clearly there's a lot of signs and that there is the inflation expectations are not completely tamed. At the same time, the hawks, or excuse me, the doves on the Fed, including Jay Powell, inflation's fine and it's going to come down, even though it's been 4.5 years above his 2% target and it remains around 3%.
Yeah. I think a couple things on that, Kathleen. So the chairman emphasized today that services inflation was coming down and it was the goods inflation that was beginning to come up. And attached to that was that's tariff effects, and those will be one time adjustments. I am not quite so sanguine that that's the case because I hear companies talking about their price elasticities and where they can begin to recoup, whether it's tariffs, whether it's wage demands from because people are complaining about their lost purchasing power over this time. Wages have not kept up with this inflation, and so I think there are a number of factors moving here that make me less sanguine about the path of inflation ahead, about people's expectations for it. And I hear it so much in the narrative, both in businesses and from households. This has not gone away. And I think until you get to a point that those expectations are better anchored at 2% across a wide range of these surveys and metrics, I think you have to be particularly cautious. And I think remembering too, yes, the Fed has a dual mandate, but its most direct and I think long-term ability to help the labor market comes through keeping inflation in check. And so that's my own sense is that really is the piece I'm watching most carefully.
The part you're watching most closely is what inflation expectations do and or what tariffs do. I mean, there's
And
also a possibility that tariffs
inflation in
might go away.
particular. Yeah, because
Yeah.
I think tariffs might end up being opportunistic in some way, right?
Mhm.
They have moved around. I think companies, some saw a very clear hit, but those have moved around in a way that they were tentative about passing prices on to consumers. They may have looked to share some of that with suppliers and other parts of their uh, network. And so I don't think we know the full story yet on how these things are going to unfold. And the real risk, as stated today in the statement, is upside risk to inflation. And that would concern me right now.
Well, that's another thing. I was at a conference recently where more than one person said, over the long term, the Fed, any central banks, most important mandate is price stability, right?
Right.
Now, in the US is kind of unique among other developed countries that there's a dual mandate. Oh, we got to watch labor market too. Under Jay Powell, though, and others who are on in his corner, Chris Waller, I'd say over the course of this year has gotten very much labor market weak, got to cut rates, right? It was one of the first ones to get on that bandwagon. But the what the labor market looks like to many people. Jay Powell thought it was actually probably weaker, and the data even weaker than they look now. In fact, he said job gains may be overstated by 60,000 a month, and the BLS job surveys have always had adjustments. Have you ever seen a Fed person trying to sort of endogenize their perception of the BLS survey into their policy choice and kind to manipulate the number that is announced? I mean, and I know we're in a different time. We had a shutdown. We had all kinds of things going on. We've had deportations. We don't let so many migrants across the border. Um, how do you then fit that into how this Fed chair, and again, the people are on his side who want to cut rates more, how they are making of all this? Other people are saying it's very difficult to assess those data. And one of the recent data points we've had, I guess it was September payrolls, look pretty okay.
Yeah. Well, we got the JOLTS data last week, which says job openings have picked up. Now, it is true, people are hanging on to the jobs they have. It's not as if they're jumping jobs. So you don't see the dynamism in this economy, in the labor market. But remember, I think when you have stated there are risks to both sides of the mandate, that you have chosen to lean on the labor side, you are building the case for where you see the weakness and why you're emphasizing that the risk on that side of the mandate is greater than on the inflation side. And again, given the number of factors that influence labor markets, the Fed is not a direct player. The Fed says in its own framework documents that, that is a more indirect path, not unimportant by any means. But the inflation piece is the one. And I think the research has been pretty clear over the long run. The contributions central banks make to a strong economy, a strong labor market really does come through keeping inflation in check. And so it is, I have a stronger sense that would be my leaning right now. Not that you don't care about the labor market, not that you're ignoring it, but there are not many signs when you upgrade your forecast to GDP, when you are showing that the unemployment rate will be lower than you had it this year, that, the risks are really outsized relative to the inflation risk.
Right. Well, exactly. And that's why it's so interesting that they're still so focused, the majority of the voters anyway, on the Federal Open Market Committee are more concerned about the labor market and feel, oh, we better watch out for that, rather than wondering, gosh, if inflation stay high and go even higher, then maybe that's a bigger problem. I want to ask you about productivity because
Mm.
Jay Powell does think it's gotten higher. Now, a lot of people look at AI, a lot of people look at all kinds of things, but so one of the reporters at the press conference asked if higher productivity means you've got a higher neutral Fed funds rate. And if that's the case, you may be a lot closer to the point. You may be at already or past the point where you really need more rate cuts. What do you see there?
Yeah, I thought that was a very interesting comment because, productivity is notorious for moving around, being hard to sort of pin down for a long run measure of productivity. I think it really is interesting that productivity has been as high as it is. And I think, when you think about what AI could contribute, I think it's too soon to know today, but obviously that could be promising. That question, I thought, uh, was a good one to say that would suggest that your neutral rate might be higher. And I think the chairman didn't bite on that. He didn't take that other than to say, part of our outlook reflects this sense of higher productivity. So it would be wonderful if we had higher productivity going forward. That does a lot of positive things for the economy, but I'm not yet willing to say that's a long run trend that we should begin to base long run policy decisions on.
It's interesting. President Trump weighed in today. Maybe it's not surprising. He called the rate cut too small. And of course, Stephen Miran, who is his first official big important appointment to the Fed as making him a Fed board governor, the 50 basis point descent, he's the guy. We can pretty much figure that for sure. Um, so it's is it that we got a president pushing for more rate cuts, and we've got uh, 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 I mean, maybe it kind of works for for Trump because Powell thinks apparently that if anything, that there's the next move. He says he wants to, they will get, keeps promising we will get to 2%, but it's not the first priority now, obviously. The first priority is to make sure the labor market has more push, even if
Support.
others would say it doesn't really need it. Um, maybe that's a perfect combination, at least for now.
Yeah, I mean, to separate two things, yes, the administration is being very vocal about what they want. And again, we can go back in history and find times when administrations were vocal.
Hmm.
Clearly, as I just said, when you're racking up $1 trillion of interest expense a year, lower rates certainly would be desirable, I think, in that sense. But the truth is, the people around the table have a mandate to think about the long run. And it will be very critical. Whoever fills these seats, whoever gets named to the chair role, once they're in there, they will have decisions to make about the posturing of the Fed's monetary policy relative to that long run. And that, I think, is what will really set the course for the committee going ahead, both in terms of its agreement, its disagreement, ultimately what that policy means for the American public.
So what do you think is going to determine what the Fed does next? We can see the divide among those who would not have cut today at all. We can see others that were happy to cut and might even be looking for one more. And we know that be given the structure of the Fed, that the fact that the Fed bank president's number 12 are 12 on the board, you get another what, nine, we get the whole 19 in the group. So I got that close. But anyway, and the board governors always vote.
Right.
So what is going to happen next? We know that people are wondering in February when it's just something to do. You don't think about reappointing
Mm-hmm.
or saying yes, continue Fed bank presidents, but every 5 years this perfunctory vote is done, and now people are wondering if somehow the president might have a Fed chair in place. He's already got Stephen Miran, might be able to somehow manage to get at least one or two more governors appointed. If we could see a case where the role of the Fed bank presidents is going to be changed if they can just be kicked out, especially at a time when several of them are very dovish and excuse me, very hawkish. Austin Goolsbee, who's usually pretty much always considered a dove on monetary policy, he dissented today. This is a
Mm-hmm.
pretty clear message. I wonder how that is all. I put a lot of elements in there, Esther, but when you
Yep.
look at what are you watching? What do you think's going to happen?
Yeah, I've heard this concern and speculation that the reappointment process for the 12 Reserve Bank presidents, because it happens all at once, could be at risk. And that's certainly, it's certainly possible. I mean, the process is more robust than I sense it used to be. I mean, before I left the bank in 2023, we were already doing more robust assessments ahead of that reappointment process to talk about the performance of our banks, to talk about externally, feedback. So I think the process has become more deliberate as opposed to just perfunctory in doing that. I also think, though, we're someone to go in and really try to change those dynamics. Think of what the reaction might be. I mean, remember, just naming a new chair always gets tremendous market attention. People are trying to figure out, how will the committee work vis-a-vis this new chairman? Will there be consensus? Will there be more division? That makes it harder for markets to understand reaction function of the central bank and how the committee is making decisions. So it could happen. I think unlikely. I mean, you want to make sure that there is confidence in the central bank. So too much change all at once will carry its own risk to that. And I think already we see tying things up in legal processes and it creates that degree of uncertainty that isn't good for the economy and certainly not good for the public's trust in an institution.
Well, then, as someone who spent more than a decade, well, no, much more than a decade, as not as certainly as Kansas City Fed Bank president, but you were on the bank supervision side to start. You were many years at the Kansas City Fed. So I don't, you don't have to try to be neutral, but tell us, remind people what the importance is of the Federal Reserve's regional banks, their
Yeah.
leadership, what they do that would be lost if that role is weakened or pushed back, or just sit there and don't dissent too much and don't say too much because we're in charge in Washington.
Well, to study the history of the structure of the Fed, Kathleen, is really to understand that the public does not like concentrated power, that the structure of this institution, including with the 12 banks, was not simply to make up for lack of technology and transportation ease around moving payments around. It was a way to anchor the institution in grassroots and garner, whether you call it political support, public support, it was to give people line of sight that their issues in the economy were getting direct attention. And so the dispersion of these 12 banks brought a diversity of what was going on regionally, was giving people a sense that someone was thinking about whether you were a farmer at the time or you were in manufacturing. And so having a board of directors on those regional banks was another expression of bringing in people from the region that would see firsthand how decisions are made in the institution. So it's very designed. I think it was very intentional in terms of anchoring a really important decision-making institution in a way that could earn public trust. And so when you see efforts that undermine that, it is concerning. And sometimes it's just changing conventions. Sometimes it's attacking things from a legal perspective. Just the evolution of technology has changed the dynamics across those 12 banks. As you know, we have tied ourselves together more tightly through automation, through trying to be more efficient with things. So many things have changed some of the dynamics of those 12 legal entities. But I think what you don't want to change is really the diversity of views, the public's ability to connect to the central bank at a grassroots level.
Another point I'd like to bring up about today's meeting and the press conference, and even bringing in the president who thinks the Fed should be cutting more. There's a big concern about the housing market. There's a big concern about affordability, particularly younger people. One of the problems is there's a shortage of new inventories, and another problem is that mortgage rates are very high, right? So is there, is somebody missing a point here? Is Jay Powell missing a point? Is the president missing a point that if you have higher inflation, and bond yields have been going up a bit today, everybody rallied a bit, but in the US and around the world, bond yields are rising, long-term yields. That's going to have a big impact on mortgage rates ultimately. So is there any way to think about it differently where you'd say, gee, maybe it's painful for a while to push up rates at the short end. But if you convince everybody you're fighting inflation and the long-term yields come in, now of course it'd be helpful too if the budget deficit would get out of control. But let's just start with what the Fed can do.
Yep.
Would that be a better way to think about how what your short-term rate cuts are going to do versus this desire to get longer-term rates down and maybe give a little help to the mortgage market?
Yeah, I think you really have to understand the dynamics of what is driving the housing market, but really asset markets generally. Look at what happened today, Kathleen. The announcement of the cut, the $40 billion that will be purchased by the Fed, sent the stock market soaring. If you have assets, you benefited from that. People that are lower, where this gap is widening, are not going to benefit from that as much. And nor will they be able to buy houses, which are already more expensive, even if it's at a lower rate. So I think really understanding the channels of our policy transmission are so important. I mean, the Fed has activated both with asset purchases, with its traditional interest rate policy, a much broader impact on the economy than it has historically. And so, really understanding the drivers of these price changes and where they're affecting the public, I think is important consideration. Fiscal policy is the other one that I wish the Fed would talk more about. Not not to try to interfere in making the policy decisions, but simply to note what it means in the long run for our economy when we begin to push out more and more debt and the pressure that will place both on the treasury market, but finding purchasers for this debt. You will put pressure on the Fed to be one of those buyers in large amounts. So I think all of this requires really careful thinking about. And again, I know people are thinking about that. I don't think there is an intention to try to undermine the economy, but there are side effects to this policies that I think you have to think about.
So, what are you looking for? Everything you've seen for now, and of course, Jay Powell, his impact on the thought of the committee may diminish a bit as closer he gets to his departure. He's still the Fed chair, very powerful, closely listened to. Look at what happened today, right?
Right.
But do you see do you see the likelihood of at least another rate cut this year, or look into your crystal ball. Do you think that some of these things are going to catch up, and including the Fed chair before he departs, maybe get a bit more on board with the idea that maybe you've cut enough, maybe you've got to look at these other considerations that are out there?
Yeah, I guess that would be my expectation. Notwithstanding, I think there is a bias to cut if, again, the data offer the opportunity. If the labor market looks like there are cracks there, that would be consistent with the messaging. But my expectation is, at least through the first half of the year, you're going to, financial conditions are pretty easy right now. You will get some fiscal impetus that's coming from uh, some people talk about the tax refunds that will come in the first part of the year, the spending that's occurring on the federal side now that the shutdown is over. I think the headwinds that people worried about could dissipate in a way that at a minimum causes the Fed to hold. And I think then watching carefully what happens to inflation. Is this narrative right? That goods prices will come down, that this trajectory toward 2% is going to be achievable in the next year or so, I think is going to be important.
Well, very important to talk to you today, as always, to get all your thoughts and a lot to weave together today. Boy, oh boy, I think the surprise of the 40 billion purchases of treasury bills and being moved much closer to now rather than waiting, and a lot of other things we heard today. But covered it all for us, as always, Esther.
Well, good to talk to you, Kathleen. We'll keep our eye on things.
We sure will. Esther George, former president of the Federal Reserve Bank of Kansas City. Again, I thank her so much for taking the time and going through a lot of issues, some of them fairly complicated, maybe a bit more complicated than usual after a Fed meeting. Even so, I'm Kathleen Hays. Thanks for joining. This is Central Bank Central.